Hey Trader Steven here. It's Thursday morning before the market opens. We're going to shoot this webinar. It might be a little shorter than usual. Not a whole lot has changed since last week, although we're starting to see, a little bit more tugging and pulling on this rally. So, let's dive right into it and start with the S&P 500. There's this line, it's probably more of a zone in the 2600 to 2620 area. That there was a lot of resistance. You can see, all this times the support. I could probably draw two lines, but let's just say it found it 1, 2, 3, 4, and then broke it the fifth time. And then, what was resistance or support turns into resistance, but it really wasn't the case, and it broke right through. And now it's sitting kind of on top of this. So, really with the S&P 500, I always, or with the market in general, I always look as the 20-day EMA as kind of the rally line. Okay, how strong of a rally is it? Is it going to stay above this 20-day EMA that's curling up right around 2600? So, we have what's interesting is because if you notice the last several times we got a gap up right here on November 7th, and then it just got slammed back down. And then we got another big gap up right here on December 3rd, and then it really got slammed down. And then we had another gap up on January 18th. Had been a couple of days ago. Was that January 18th? Yeah. So, so we're going to find out if, third time is a charm, or if, as of right now, I mean, you can see the last two times this happened, it absolutely sold off and then sold off. And now, we punched through resistance, and we're really in this, zone right here where there's just even more overhead resistance. So the market has a lot of work to do. We're still in a bear market. The 50 is under the 200-day moving average. In my opinion, this is a bear market rally until it's proven otherwise. And it's just like, you might say, well, Steven, it came 11, 12% off the bottom. I mean, I could show you a lot of past correction in bear markets where it's done more than that, and then it just rolls back over. So I'm not predicting, but we are in a bear market, and until we really break these highs right here, we have to assume the trend is at least going to continue, or at least, we're not out of the woods until these levels are broken. Because you can see right here the 2816 level, and that created a high, and then you had 2815 never made above this level, and then you had 2800. So you had a series of lower highs. So it is clear that there is something going on around this 2816 at probably 2820 level. It doesn't have to be exact down to the point that the market needs to clear before we can say, okay, we're in a better environment. Yeah, me personally, I do think this could be a challenging, maybe choppy year, but even in choppy years, man, you can get nice rallies, right? Even if the market ends up with zero at the end of the year, if you know how to catch these trends and use moving averages as stops to just get out the way, you're going to be just fine, and you're going to beat the market that way just because you have your exit strategy. So, right now the market, pre-market Thursday is, set to be about a mixed bag. Dow down a teeny bit, Nasdaq up a teeny bit. We don't know what is exactly going to happen here, but it's important to look at history and see the last two times the market gapped up on this downtrend, what happened. So all I'm saying is, if the market really, if it comes all the way down to here and breaks this pivot, this 2570, this pullback right here, I would definitely be getting out of the way. But I'm definitely going to be raising my stops if it starts to break the 2600, or even this, where is that 20-day moving average? 2592, 2593, where it's currently at. Market cracks this. Boy, I'm raising stops or cutting my weakest stocks in my portfolio, and then if it takes this out, then I think that completely opens the door for a retest. And I say a retest because it doesn't mean it has to undercut it. It doesn't mean 2008 type of scenario. It doesn't mean the sky is falling. It just means more chop is ahead, and you need to protect your measures, protect any gains that you made on this trend. Now, if we go over to the Nasdaq, let me get a sip of coffee real quick. If we go over to the Nasdaq, the chart looks very similar, but I do have this price by volume on here just to kind of show you. And what this is you know, in this zone right here. These are all the shares that were traded, so you can see that really between, let me see if I can make this measured move. Let me see if it'll let me kind of do that. So you can see between 7,000 and 7,465 approximately. In this zone right here, there are a ton of shares that were traded, especially on the downside. So there's a lot of overhead resistance, and we're in the middle of it. We're in the middle of this range right here where all these shares were traded, most of them to the downside. So just kind of keep that in mind. Again, most of the time, I always have, the market has an upward bias, so I tend to have an upward bias, but I also have to look at the evidence and say, okay, we're still in a downtrend, you know, we're still in a bear market. It's 50 days way under the 200 day. This price action is still way under the 200 day, you know, so, but we are in a counter trend rally, so we're just going to kind of have to wait and see if this zone holds, if this 6,800 zone holds. For the Nasdaq. If it doesn't, well, we just talked about with the S&P 500. So, you know, let's look at the breadth, and we're going to look at some sector ETFs today. So let's just look at the short-term breadth real quick. So, you know, this is the percent of stocks above the 20-day moving average in the S&P 500, and what you want to pay attention to. So 82% above the 20-day moving average. That's good, right? That's a nice little rally. But what you want to pay attention to is when it starts to kind of get back under the 70 zone, kind of go back down, and if the market the price action is still holding steady or headed higher, and you're starting to see this dip, that means that fewer and fewer stocks are pushing up the market. So we have our individual industries, and this just tells us which are the strongest ones, right? So you have technology. It's still pretty strong, but it's starting to take pause. That's no real sign to kind of worry about, you know. Financials are clearly, you know, the strongest out of the aggressive groups. And the XLF, you can see right here, 98% of those stocks are trending above the 20-day moving average. So, you know, that might be a good honey hole to fish in, and mostly because banks usually report earnings first. So you get those earnings reports. If there's some positive, you're going to get some banks rallying out of this. You have the consumer discretionary, which is 80%. Industrial 86, a little bit stronger. Healthcare 85, so all pretty strong. You can see staples, more defensive, are starting to kind of play catch up at 72%. Energy is looking like it's rolling over, so we can look at that industry in a second. But just keep in mind this chart, and what that means is we're going to look at XLE, and if the price action hasn't really budged, you know, what that means is that fewer and fewer energy stocks are pushing up the market, and that's not good. For the energy sector. You know, what really stands out to me is financials and utilities, because you can see, you know, financials really sold off, and then they have just been charging higher, which that's not always what I want to see. That's not the end all be all, but utilities are defensive in nature, and they're really starting to strengthen. Why some of these more we'll say aggressive, you can see materials are weak, but some of these more aggressive industries are kind of taking pause, and utilities are getting weaker. That again, you know, I'm not going to throw a fit about that right now, but let's look at some more breadth charts. Just kind of a bigger picture. You can see that 40%, 41% of stocks in the S&P 500 are above their long-term 200-day moving average. That's not that great, right? You want it above 60 to kind of confirm an uptrend. We're only at 40, so most of the stocks, majority of the stocks, 59%, 59.2, whatever, are still below their long-term moving average. So just put that into perspective. You know, you want to invest in a safer environment, or when the odds are in your favor, and yeah, you want to catch some rallies, and yeah, it sucks if you're not fully invested in the markets rallying against you, but keep in mind that bear markets have bear market rallies. You know, just like over here in 2015, you rallied 13% off the bottom, and then it just absolutely rolled over. I know it's kind of hard to see that because of the volume, but I mean, that's what happens. So let's go over to let's just look at bonds real quick. The chart does look similar to last week, but I talked about last week that if you've read John Murphy's book, Intermarket Analysis, he's phenomenal. He really knows what he's talking about. Plus, he's kind of the stock charts guru. He talks about these cycles, right? And you have bonds, commodities, stocks. Well, typically, what he says in the economic cycle is, or what a lot of people say is, bonds historically have peaked before stocks. So you got bonds that peaked way back here, 2016. But they typically bottom before stocks too. So see, bonds, have sold off. They've been in a 2-year downtrend and now have broken out of this downtrend and are now surged above. That is a thrust. Cleared all these points. That is a new trend has emerged. Pull back, test this zone, and it could chop around here a little bit. 111 to 123. I mean, that's a good move, but that's not like exciting like a stock. But I mean, the point is that the bonds are starting to bottom, and typically bonds bottom before stocks. But you can see bonds topped way before stocks did. So, if this starts to merge and money starts to flow back in, we could see this push up. So, you can always keep an eye on the bond market to see, what potentially stocks could be doing. So if we go to, what was some other charts I was wanting to look at? Let's go to the dollar right now. Let's just kind of getting too many charts up here. Let's just kind of take a look at that. So, I'm really unsure about the dollar right now. The long-term trend is up, okay? So you had a long-term downtrend. The long-term trend is up. And you can see right here that it broke out of an inverse head and shoulders, hit higher, pulled back, false breakdown, broke out, and is now really coming back to test this breakout zone. So I'd say if this 95.27 level fails, that's going to be incredibly positive for gold, which we're going to talk about here in a minute. Or it could just go sideways for a while. It made a big move in 2018. It could just go into sideways consolidation. Okay, so, it's interesting because typically, I think the dollar, so we're going to have to kind of let this play out. We really don't know which way it's going to play out right now. Sometimes it can take months to kind of figure out, but, just pay attention to the trend. So you can see right here when the dollar is strong, this is a relative chart of the S&P 500 versus emerging markets. You can see how strong relative the S&P was to the emerging markets, meaning the U.S. outperformed emerging markets. And now that the dollar's been going sideways a little bit, even going down, you can see the relationship. The S&P is underperforming emerging markets since the dollar is starting to weaken or at least consolidate. Same thing with the international stocks. You can see when the dollar is strong, S&P outperforms. When the dollar starts to weaken, the other way around. So, and typically, when the dollar does get strong, small caps outperform the S&P 500, and when the dollar starts to take pause, you can see small caps underperform large caps. So it's funny how these relationships really do work. Let's go over to GDX. So, this is a chart we've been looking at a lot lately, and I could make the bullish case and I could make the bearish case. But, GLD up here, it's broken out. It's starting to take pause, pull back a little bit. So I think that's okay. So again, I think that if the dollar continues to find support and bounce, I think that gold could roll over. So if we're looking at the GDX, the miners, you can see that this 20 to 21 zone found support 1, 2, 3, 4, 5, 6, 7 times, broke it, and just sold off a map. It's funny how quickly when support breaks, you can just see it just get slaughtered. Now it's trying to come back and really struggling through this zone, but I could make the bearish case and say, okay, it hit resistance and pulled back and it could not get through these levels, and then I could make the bullish case and say, okay, well, it's just shaking you out. A bunch of money, hands are being exchanged, and it's pulled back to the support of this pivot right here. So, we're going to find out probably in the next week if this feels like it wants to bounce or roll over, but I would keep an eye on GDX because, if I were to pull up a different chart, which I will here in a second, it's kind of sitting on the 50-day moving average, so one could easily call this a retracement. you also, got to keep your eye on the dollar. The dollar did break this trend line that had been going on since the middle of 2018 and is now kind of sloping down, but it could just kind of turn back around. So I wouldn't say this is a definitive, just all of a sudden in a bear market. But when you're investing in gold and gold miners, you want the miners to outperform the metal. And you can see that the miners broke out relative to the metal and then started to roll over and then could get some life. But right now, there's just not too much going on, but it could change very, very quickly. Whereas if you look at, GDX, you can see right here on the shorter term chart that, it broke out of this pivot like we previously broke above the 200-day and is now pulled back. And it's kind of sitting on this 50-day moving average right here. So this could be a low risk entry with just a stop under these days. And if it breaks out, you didn't really risk a whole lot. But if it works out and gold does turn around, you could be good. So I did put out a short piece on gold, and then all of a sudden started to firm up around the moving averages. And some if you look at RING, which is the iShares version of GDX, you can kind of see down here that, it looks very similar, but there's starting to be some volume that is accumulating around this area. So if it breaks above kind of this level and starts to climb the right side, I would definitely say that's a buy signal for miners. There is a couple other charts I want to look at. Let me on the gold side. So let's look at this, and this was a chart I did get from Martin Pring, a stock charts analyst. But the relative ratio, the gold versus the S&P 500. Gold late last year broke out relative to the S&P 500 of a 7-year downtrend. So what this means is, if all this price action is going down, and this is a relative chart, it means gold is underperforming the S&P 500. It doesn't mean gold is going down, the S&P 500 is going up. It just means it's underperforming it. Well, all of a sudden, you kind of have a trend change right here, and, could just be the bear market, and this is going to come back down. But I think it's a development worth keeping an eye on, because, like I've always said, all of a sudden, when you get a personality change in an instrument, whether it's gold or the S&P 500 or a stock, that's time to wake up. Whether, you have an uptrend and all of a sudden it starts to get wide and loose, you might want to take some profits. Or, if it's in a downtrend and all of a sudden the momentum really starts to slow to the downside, something that you want to really, really keep an eye on. So it's just an interesting chart to look at in my opinion. Now, if we go back, I got a lot open right here. Let me kind of close all these, and then we'll kind of go back to the dashboard. And, yesterday, Wednesday, was a wild day. You can see it started high. It just absolutely sold off midday. Then came back and got most of it. So just kind of a wild ride, and we're just going to see how it continues to play out. Let's look at some ETFs. Let's look at some of the sector Spyder Etfs. Let me kind of do 10 per page here. So, this is the and most of these are going to look the same, but we're trying to see, what's the strongest and what's the weakest. So you can see that consumer discretionary ETF is still in its death cross, right? And is kind of back in the zone. And this could, come back, create kind of a handle, or even, a shoulder, and then get out of this downtrend. But right now, this is kind of looking like the market. Technology, the XLK, it's still right at the 50-day moving average. So it seems to be, I wouldn't say struggling. I mean, it could just pop out of here today and be just fine. But, I mean, again, if all of a sudden we're in rally mode and then it just starts to chop, that's a personality change. So it's something you want to pay attention to. But the 50-day is way under the 200-day. So, it's not a great environment. Industrial is stronger than tech. And you can just tell by where it's at. This is a steeper trend. It is a pullback. But again, what stands out to me are kind of these island reversals, right? You got the gap up and then it gets slammed down. Kind of a gap here and then it gets slammed down. You got a gap up here and then you're down for 2 days. Is that going to happen again? Materials, the breadth we saw was starting to look a little weaker, so we'll keep an eye on that. But again, this, I think there's better things to invest in. Energy, if it breaks this 61 level, I would completely get out of the way, because you can see it kind of, you know, trade sideways in a nice and neat pattern. Pop is coming back into this zone to retest, but it could absolutely roll over. Consumer staples, you know, the funny thing is this is one of the only ones that are still have their 50 above the 200-day, but you know, it's funny because even staples, even what's supposed to be defensive in nature and protect you from the downside, I mean, that absolutely got slaughtered in December. So it might have been one of the last ones to go, but you still lost money. In 2008, everything pretty much lost money. So, you know, sometimes just the way I see it, the staples, yeah, they might sound good, but they're not always going to protect you. Healthcare, the 50-day, this is kind of a sector I like, just because he had one of the strongest trends before the bear market. And then on this rally, it actually got back to the old high. Yes, it didn't close above it, but above the 50, above the 200-day. That's bullish right there. That's kind of what you want to see. So I'd be checking out the healthcare industry. Utilities is below the 50, but above the 200-day. So again, you have two of the three sectors where you still have the 50 above the 200-day that are defensive in nature. So, you know, just goes to show you the kind of environment we're still in. And then you got financials, which have really started to pop since earnings. You can see right here, popped on earnings, popped again, closed in the upper end of yesterday's range. Looking pretty good. So I like what I see here in financials, and if it kind of goes sideways, or if we do get a pullback or another leg down, you want to pay attention to which industry or which sector doesn't come all the way down or as far down as the S&P 500. What's holding up relatively well, because typically all sectors or all bear markets are, you know, they're going to take that second leg down just because they have to digest, right? They have to digest the downturn. Which one on that second leg is down the least? That's your honey hole. That's where you need to be fishing in. So if we go, let's just kind of go to the sector summary real quick just to see. Let's kind of look at the 1 week. Kind of look kind of like this. Okay. Let's just look at the last 10 trading days. So financials are the clear winner. These are all the industry groups. Communication services, that's the new sector ETF added. And then energy is down in the last 10 days. So those are definitely the weaker. But you have financials that are up. Real estate is up. So REITs, kind of defensive in nature. Staples that are third. Industrials up there too. But really financials, I would say, are the standout. So what I look is like any day starts the day, I'm always like, what's the strongest? What's the weakest? Because, you know, that just kind of tells me the mood of the market. What industries are the strongest? Which ones are the weakest? Financials the last 10 days are looking good. So might be something to pay attention to. Really right now, that's all I got. Shorter webinar than last week, just because I think right now that, you know, even if we go back here, just let me click on the S&P 500 chart. Oops, I didn't do it. You know, right now we're kind of waiting to see if, let me kind of look at the daily. This is the daily chart. We're kind of waiting to see if this is just kind of just a normal pullback or if something's going to break here. So really just make sure you have your stops in place. Don't pay attention to where the market starts for the day, or not as much. You want to pay attention to where it finishes. If it starts weak and finishes strong, that's going to give me a little bit more confidence. If it starts strong and finishes weak, then I'm going to really start to pay attention and say, okay, something's not right here, because you don't want that to happen. You want the market to finish strong for the day. So I hope this was helpful.